So we're very excited to have everybody show up. This is a nice little turnout. My name is Martha Wisner, and I'm the AVP Mortgage Operations Manager for SCU Credit Union. And we have our staff here. We have a guest realtor, and we have an attorney, and we'll introduce the names as well. So we're going to go through the whole process of the whole mortgage process. Oh, here it is. Here before. So how many of you are first-time home buyers? 100%. Okay, very good. Yeah. Very good. How many of you are actively looking at this? Okay, very good, nice. And how far are you in the process?
Since March.
Oh, okay. Wow.
February.
February.
Yeah. Wow, great. Nice.
Okay, so this is an overview of what is needed to purchase your home. And we're going to cover a number of different items such as credit, how important credit is, how important a realtor is. We're going to have one of our mortgage loan originators talk about the role of a mortgage loan originator and the involvement that she will have at all the gathering the information, reviewing the initial information that you provide, and we'll talk. So there's a lot. She's a point of communication. And then we have backshop people who are, we have 2 senior underwriters here as well. So I'm just going to start. So I introduce myself. We have Robert Stevens. He's our senior underwriter. He's going to talk about credit. We have Carolyn Harrington, that's another senior underwriter. Ingrid Williams is our mortgage loan originator at the credit union. And we have Tassos is let you in downstairs. Coming up any minute. He's a branch manager. I don't know what branch he's at now. Walpole. Okay. He's at Walpole. And he's going to cover the whole pre-qualification and pre-approval process. He's very well informed with that and very good with that, with people who walk in, customers. We also have Stephanie Weinstein, who is a guest realtor speaker. We asked, she joined us last minute, so we're very excited to have her here. And we have Scott Syed, who is our attorney, closing attorney. He has his own firm, which is law offices of Scott Syed. Worked with Scott for many years. Very good. And so as a brief overview, because we are going to go into quite a bit of detail, we're going to talk about obtaining and reviewing your credit report, the positives about doing that and the importance of doing that. Also about getting a pre-approval. And we're saying from Sharon, we prefer that you would come to us, SCU Credit Union, and how important a pre-approval is. To give you leverage when you're looking for a house, and it gives you maybe a little more strength over another competing buyer. So we're going to go over that and how to prepare for that and what it means. And also we're going to go over about selecting a real estate agent. Stephanie's going to cover a lot of information on that and the benefits of having an agent. And then the next point would be to shop for your home. And to know what you can afford and what makes sense to you, what's affordable, what you're comfortable with. And then also, one thing to consider is getting your own attorney if you wanted to assist with your purchase and sale agreement. That would be, Scott will go into that, but that would go over, that's where you can negotiate with the buyer, the seller about certain items that you might have to include in a purchase and sale agreement. And then you would close and then purchase the house and then close with a mortgage with a lender's attorney. So we have our own attorney as well that you're closing, and that's where you would sign the mortgage, the note, promissory notes, and other disclosure documentation. We deleted this. It's moved down later. We're going to cover that later. Moving on.
Delete it.
I don't know to go into his version. Okay. All right. So we're going to start right away with the basis of credit reporting. we're going to share a number of slides, so I'm going to hand this over. And also, if you have any questions, we're just going to ask that you hold them to the end, maybe write them down, and we'll just cover them at the end. Because we might cover the information during the whole process. Just ask that you do that. Thanks.
Again, thank you for coming. And credit is one of the important pieces of the process to get pre-approved. Think of it as a table with 4 legs. You have credit, income, assets, and the property itself, the appraisal. So credit is one of the most important keys to get started. So on the good life, there's a little cartoon here. The good life starts with good credit. So makes things a lot easier if your credit is good. So what is your credit history? It's identifying information. So once you apply for a credit card, or even if you sign, you apply to get approved for a lease for an apartment, they capture all your information, your name, your social security number, your address, all that information gets compiled. Residential and employment history. Very often when you're applying for credit cards or loans, you're putting who your current employer is. They capture that. And again, as I already mentioned, you get, if you're applying for housing and, to get an apartment, they're going to, get all that information as well. So account information also includes your payment history. So the bureaus are getting reports from all your creditors, usually every month, and some of them might do it every 2 months, but they're reporting, are you paying the on time, or are you paying late? And if you're more than 30 days late, then it shows up as a negative on your credit report. And if you pay it within the time frame you're supposed to, then it counts as paid on time. So as you build your credit, the more accounts you get, the more credit you open, you're starting to expand your credit history. So on the negative side, judgments get reported. So if you went through an eviction and the landlord files that they find a deficiency of, say, a couple $1,000, that can get reported on your credit. Anytime you have a bankruptcy, a foreclosure, if early termination of a lease could happen if it's a negative situation, that could get reported as negative. An auto repossession, if you have to sell your house, short sale it because you can't afford the mortgage anymore and there's a deficiency balance, all that gets reported on your credit. Recent inquiries, the credit history, they go back 2 years on how many times lenders or creditors have looked into your credit. In applying for a mortgage, we focus on the last 120 days. So we're looking at how many accounts have been opened in the last 120 days as an indicator of what's going on. Now, if you're shopping for a mortgage and you go to 3 different lenders, the bureaus are actually smart enough and they'll count that as usually one credit. If it's in a very tight time frame, it doesn't count against you because the scores are the way they calculate the scores. They're smart enough to realize you're looking for, say to buy a car, you might go to 2 or 3 dealerships. You might go to 2 or 3 lenders to buy to qualify for a mortgage. Any disputes? So if you dispute something on your credit report, they actually will report that you're disputing it if you call in. So where does this information come from? It's all submitted by your creditors and by public records. So anytime you have a judgment or a bankruptcy, that's a public record. So it pulls that information as well. Okay, so how do you build your history? The process begins when you open an account and you make your payments. The older your credit becomes, the better, because now you have an established credit history and it's going to accurately reflect on your payment history and how much credit you've opened and They also look at the percentages of balances. So if you have a credit card with a $5,000 limit and you're paying it every month, that reflects positively on your score because you have low utilization. But if you have 3 credit cards and you've maxed them out and you're close to your limits, that actually hurts your credit because now you have less available credit. So that all gets factored into your credit to when they come up with scores. The credit bureaus update their records usually monthly, sometimes every other month, to how your payment history is going. So what's not in your credit history? Any criminal background information is not part of the credit report. Your medical history is not part of the credit report. Now, if you have a medical bill that gets put into a collection status, then that would report as a collection account, but it does not involve any of your actual medical history. That is not part of the evaluation. They don't analyze your habits and transaction histories. They're just saying, is it paid on time or is it not paid on time? Are you current or are you past due? They don't figure out oh, well, you go to Best Buy too many times a year. That doesn't get evaluated, and what your habits are. Your bank account information is not part of the credit report. Only if you have a if your bank account goes into a negative balance and you don't pay it, eventually the credit bureaus the bank can report to the credit bureaus that you have charge off on your your checking account or savings account, but they don't include where you bank at Citizens or of course if you want to bank at SCU Credit Union. But and also they don't actually give your credit scores on your credit history. That's provided by another source, which will be discussed a little by the next speaker. So what is a credit score? It's an automated way of analyzing a credit history. So there's a range between 400 and 850. And to come up with the score, each bureau that comes up with a score, and how they do that is they look at how old your credit is. We already discussed your utilization. If you've maxed out your credit cards or your utilization's low and you're paying it every month, they look at how well you pay it. So all that gets factored in. They have these very complicated and complex algorithms that come up with how they come with the scores, and they range anywhere from 400 to 850. When most mortgage companies want to see a score of 620 or higher. If you're under 620, it becomes much harder to obtain financing. So, and the credit scores are used for mortgage applications. They're calculated a little differently than those provided for other purpose, like a credit card or a auto. So what can impact your credit score? Your payment history, good or bad, how much you owe, which we talked about, how long you've had your credit. So more established credit is better, as you build your history. Your credit mix. So, they look at are you heavy on charge cards, or they look at if somebody's credit cards or installment loans. So they look at the mix of your credit, like what type of credit are you opening up? We talked about the number of inquiries, and new credit can impact. So when you open up a new account, your scores are going to take a temporary dip because now you have a new account with no history. So your score dips, it'll go back up as you establish your history and you pay that new account on time. And revolving debt usage. Whenever you get over 30%, so example, you have a credit card with a $10,000 limit. If the bureau is getting reported that your balance is 30% or higher, that's when your credit scores start getting impacted. So that you want to be careful of when you're shopping, when you're ready to buy a house. If you get those, if you get that utilization down, that's going to improve your credit score. So is this where,
Yeah.
yeah, okay, so I am going to step away, and Carolyn Harrington, who's a senior underwriter as well, like the credit union, is going to cover the next few slides.
Thank you. Excuse me. Hi, everyone. Thanks for coming. So, why do the credit histories and scores matter? Basically, if it's almost like a resume as far as a credit report goes. When you apply, that's one of the first things that the underwriters are going to look at is your credit history. What reflects in that credit report shows how you've been making your payments. If you're making them on time, there's no lates, you're keeping everything in track, then that leads us to assume that that's how you'll repay the credit union. Okay, so your mortgage. So if you're making timely payments, not going crazy with the credit cards and the overcharging, that type of thing. If you're making good, steady payments, then we'll believe that you're a good candidate for repaying your mortgage loan. Credit reports get pulled besides just for mortgages. They also are pulled for employment background checks, apartment rental applications, and utility companies. Sometimes you'll find on the credit reports, we've noticed that if you're building your credit, some people do put on there, they'll self-report the utilities if you're trying to build your credit portfolio, if you don't have too many accounts. And you can actually contact them and provide like your current utilities. And they'll report them that way to show that you're paying them on time. That can help you out as well. So the permissible reasons for requesting a credit report. You can obtain your credit report, helping you either open or manage your credit accounts, making offers of credit, employment purposes, business transactions initiated by the consumer, underwriting insurance, court orders, eligibility of government licenses, and disclosures to the consumer. So these are different reasons of why your credit can be pulled, why you can pull your credit report. Okay, so who maintains credit histories and provides credit scores? All of our first mortgages, we pull a tri-bureau credit report. 3 companies are the Experian, Equifax, and TransUnion. So all three companies will report on our one credit report that we'll pull. They'll also pull and provide, not the credit bureaus, but the information's pulled and an outside company actually develops your credit scores based on the information that each one of these reports pull. So with Experian, Equifax, and TransUnion, depending on how they're reporting for each of you, you'll have a different credit score for each one that are based on the information provided by each one of those credit companies. So that credit score they will differentiate. You might be 10 points different between the two or even more, depending on how they're reviewing your report. As like Robert said, it's a very complicated system that they use to calculate those figures. But we do pull the three bureaus. So how to build and manage your credit history. Have a plan. You know what your goals are. You're all here for first-time home buyers, so you're all looking to buy that first home. You want to establish a credit history. So typically, I think to even generate the credit score, you need at least 3 active trade lines. So that being either a secured loan, whether you have a car loan, credit cards, an installment, or a personal loan, you want those 3 active accounts to report on your credit report. Always pay as agreed, pay it on time, pay it early. A great way to make sure that all your payments are on time is if you set up like an auto pay for your bank. You know, if it's that same steady payment every month, sometimes that's a good way to be able to make sure that you're keeping your payments within time. Use that caution opening or closing accounts. Opening too many within a short amount of time, maybe maxing out those cards or, getting high limits on it. That's not going to do well on your credit, for your credit score. Same thing with closing accounts, like Robert mentioned, the longer you have that account open, and you're paying well on it, that's keeping your score up. So if you go and close that long-standing account that you've been making great payments on, that might take it down a little bit. Okay. Apply for credit judiciously. I mean, Christmas time's coming. Everybody's going to be offering you all those free discounts on the credit cards. I've done it myself when I've all of a sudden opened 10 accounts and I've closed them all right away too. But so you want to think about that. Time and performance are key. Demonstrate stability, show that you're, making all those payments on time, and you really just want to make your credit work for you. You want to be able to, use what you need, make those payments, and get your credit score to go up. So you can actually receive your credit report. You can regularly request a copy from www.annualcreditreport.com. And I think we put this page in your folders for you. Or you can contact them by phone or by mail. I was reminded earlier today that you get one free report a year from each bureau. So when you go to order it, only order one bureau at a time. So maybe you can do Experian the first time, and then 4 months down the road, order it through TransUnion, and a few months down the road, order it from Equifax. Thank you. That way there you're getting to see your report 3 times throughout the year instead of that one report from all 3. Okay. But that's a great thing to do. It's keeping you in line. You're going to see actively what's going on with your credit. Also, it's good to do it with the fraud and everything else that's going on. It's just a nice way to kind of follow up and know that things are in line and nobody else is using any of your credit. Okay. How to correct. So if you get your credit report and you see something on there and you've never opened the card, or you know that you paid it, or there's charges on there, you can contact the credit bureau directly. Typically, they'll have you submit something in writing requesting what you're disputing, what you think is an error on your report. It has to be directed to an actual account, a specific account. So if you have 3 things on there that you don't agree with, you'd have to do one for each individual account. They'll go back and they'll mark your credit report that you're disputing the charge. So if anybody else goes and pulls your credit, they'll know that you're in the process of trying to straighten that out. The credit bureau will go and contact the provider of that account to verify the information. It takes about 30 to 45 days for them to fix it. I mean, mistakes happen and they go on there pretty quick, and resolving, like anything else, can take a little time. And they are responsible to make the corrections to your credit report and to notify the other bureaus that an error was made, and they'll update their individual reports as well. Okay. So I am going to hand you over to Ingrid. What are you talking about? Oh, being an MLO. Yeah, I'm gonna leave that the arrow to the right. And she's only using the crutches for sympathy and attention. She's really fine.
Carolyn didn't trip. Hi, again, welcome. Glad to see so many team outfits. So I'm going to repeat a few things that Carolyn and Robert went over. I am the person that's going to help you get everything together and all of your answers straight before the underwriters are reviewing the file, or we're going to do our best. So We're gonna go over your credit history. If there's anything that shows up that I see from the initial application. Oh, sorry, I was supposed to do this first. There we go. Thanks. So I'm gonna go over the credit history, the increase, things like that. If you know there's something on your credit before you're applying, you may want to just jot down a simple explanation because the underwriters are going to say, oh, you had this happen in, 2 years ago. What happened? So they will ask what happened so it can explain that. They do want a full 2-year employment history. When we're using your employment history, they're going to use your gross monthly income. So before any of those deductions come out, we're going to use that figure. And then liquid assets can also be helpful, and liabilities and debts. We're going to go over all of those together. For which one is next? For your income and employment, as I just said, it's a minimum of 2-year consecutive employment history with no gaps. That's not to say if something happened, life happens, things happen, you have to help family members. As long as we can go back a little further if we need to, if you're out on maternity leave or if you had an injury, you were out of work. And then again, we would just look for an explanation as to why you weren't working during that time or what the cause of the gap was. Should take my glasses off. I can't see without them. We can use some income from part-time or second jobs or even seasonal employment, but we do need a 2-year history in order to use that income. Documentation you'll want to collect and have ready the time of application. 1 month worth of pay stubs for 1 or 2 jobs, whatever jobs you're having. The previous 2 years of W-2s or 1099s. If you're self-employed, we do need 2 years federal, business, and personal tax returns. And then you'd also want to prepare a year-to-date profit and loss statement. For Social Security or disability income, we'll need a copy of your Social Security award letter, 1099, most recent signed federal tax return, or other proof of current receipt of those payments. Child support and alimony. We would need a copy of the court order or divorce decree, separation agreement. And then we'd also need to document at least 6 months of your receiving those payments. In some cases, they will ask for 12 months if there was a change in the amount or if anything came up with those. So when you first talk to me, if you haven't, a lot of times I end up talking to you after you've already submitted your application. However, if you're calling ahead of time, we'll go over the different programs. For our Smart Start first time homebuyer program, you'll get additional funds, $500 off your closing costs. With the Smart Start, we differ from other pre-approvals because we are going to give you an actual underwritten, fully underwritten pre-approval letter. So in some points you can get an approval, but it's not fully underwritten. So when you go to have the seller, or usually it's the seller's representative that won't want that type of a pre-approval letter because it's not a guarantee you're getting that loan. It's saying you gave them, they went off what you said. We're actually verifying all of the information. With our Smart Start pre-approvals, we do pull credit, we do a full underwrite, and it's a formal approval that we're giving you at that time. We do offer those for both fixed rate and adjustable rate mortgages. And then the down payment and loan to value. If you don't have 20% down, we have to obtain what's called PMI. Someone going over?
No, if you wouldn't mind.
Okay. So we have PMI is mortgage insurance. It's required anytime you don't have 20% down.
Insurance actually covers the bank.
Private mortgage insurance is insurance that you would require. It covers the lender. In the event you would go to foreclosure, it's in that situation. if there is a shortage between the amount that we would sell the house for, including attorney's costs, fixing the house, any expenses, and then if we, and plus the loan that you would owe us, we add all of that together, and then the house is sold for a lesser amount, the insurance covers up to a certain amount of that shortage. So, and because it's all, a lot of this is all statistical and risk-based, so that they find that a lesser amount that you put down, the higher the risk is for maybe the equity not being there as much as it was when you went and purchased the house. It went down. Maybe the house has, if we go to foreclose, maybe there's some damage done to the interior of the house that has to be repaired. And so bills add up until we can actually sell that house and get that funds back. So it covers the lender and it's put on you to pay a premium, and it's a monthly, we do it monthly, so it's a monthly premium. And the more or the less amount that you put down, the higher the premium. The risk is a little. So if you put just 5% down, your PMI monthly premium would be higher than if you put 15%. And it's based on location, where the property is. It's based on credit scores, where the fees to loan to value, to determine what that is. And your debt ratio.
Now that I know, I'm supposed to dive a little deeper into some of these bullet points. The fixed rate versus the adjustable rate mortgage. I just want to go over that. Does everyone know the difference in those two? What those numbers mean on the adjustable rates? So, but the fixed rate, it's exactly that. Whatever the rate is that we're telling you that you're getting, that's the rate that you're going to have for whatever term you chose on that loan. The adjustable rates, the first number is how many years that initial rate is good for and how long that rate's locked for. The second number is how often it can adjust thereafter. So we have like I'll just do a few examples. A 5/1 adjustable, you're fixed at that rate for 5 years. And year 6, that rate can adjust. It'll be recalculated. You'd be notified 45 days prior to the rate adjustment as to what that rate can be. And then every year it'll be reevaluated and your rate could potentially go up or down. We do have a cap. It's capped at 2% per adjustment, with a lifetime cap of 6. So worst case, very, very worst case scenario, it can go up, but very best case scenario, down. I might have caught back up. Sorry. Sorry about that. PMI is not my normal conversation piece. Tassos is next. Thanks.
Hello, everyone. My name is Tassos, branch manager for the Walpole branch. I'll be talking about pre-qualifications versus pre-approval, which was the smart start we were talking about earlier. So, choose down. A pre-qualification is something you do when you're almost ready to get into the market, or you're near that point where you're ready. It's pretty much, we just run numbers for you to see how much you actually qualify for a mortgage, just so you have an idea where you're standing before you start paying money for credit reports and pulling the trigger for an official pre-approval. I usually use a calculator for that. We just use stated numbers to get that number for you. But if you want more precise numbers, we can use your pay stubs and get you a little more accurate. So pre-qualification certificate assists potential home buyers in determining their borrowing power based upon unverified self-reported financial information, income, assets, liability information used to calculate debt to income and amount of potential mortgage. So other than that, with a pre-qualification, you leave with a certificate that says that you qualify for up to a certain amount of a mortgage. You're not approved for that amount. It's just more of for your knowledge, or even the key to the real estate broker to show you around houses so they know up to which point, spectrum of house they can show you. The next step is when you're ready to start a Smart Start program, which Ingrid was talking about. And that's an actual official application where we complete the application for you. We can also do it online. We collect certain documents that we need for the application process. Once approved, you have a 90-day window to shop around. And once you find a house you're interested in, you can actually place an offer. With a pre-qualification, you cannot place an offer on a house. You could qualify for a certain amount with a pre-qualification, but there's other factors like your credit or job stability or anything, something could be something else random that might not qualify you for an actual mortgage or pre-approval, marketed as a Smart Start program. So as it says, strengthen your position as a serious buyer with a full document review. In a tough market like this where there's not much inventory, and you're ready to start shopping, your best bet is to go immediately with a Smart Start. We can run numbers for you with a pre-qualification. If you feel like you're there, just do the pre-approval. If the 90 days expire, that's not a problem. We can just re-pull your credit. You just have to pay the fee for the new credit report and get you pre-approved for another 90 days and continue shopping. Again, there's a $200 Smart Start fee, which is more like a security deposit in case, which you get that credited back at the closing when you finalize the mortgage. It's just more in case you walk away or you don't want the loan anymore, to cover the cost for our underwriters and all the other labor we've put into getting you pre-approved. A pre-approval commitment letter tells home sellers that you have the ability to qualify for a mortgage of a specific amount. Know how much you can borrow and down payment requirements based upon credit, financial, and employment. So again, there is a 5% minimum down payment that we require for a mortgage. 20% or more avoids that whole PMI scenario as Ingrid discussed earlier. Other than that, down payment requirements vary depending on the type of property. If you're buying a single family, condo, multifamily. If it's a multifamily, we will require larger down payment. I think it's 15% for a two-family, if I remember well. 3 to 4 families, 25%.
Got it.
Okay. And strengthen your position as a qualified serious buyer with the SCU Smart Start program. Anything to add that I missed?
The big difference between the pre-approval and the Smart Start, the Smart Start will go through a full underwriting, will be reviewed by the underwriters. So that's like a full verification where,
It's official.
and that's the difference between the pre-approval. Those are done by the branch managers,
Yeah.
and they haven't gone through the full underwriting process.
Yeah, and even just, like you can call me or run a pre-qualification multiple times if, you just want to see where you're at 6 months later and you want to check again to see if you're in a better position. We're here to be bugged, so.
Another, if I
Can
can.
Yes.
And add another benefit of the Smart Start program we find is that you have to provide us all of your pay stubs, any income documentation that is applicable to your type of employment. So we have all of that. Good for 90 days. And so the only thing that we don't have is property. So we have every other facet of the application except the property. So you have this commitment letter in hand for a realtor, and it gives you a little more leverage with timing. So you could actually maybe close on that loan a little quicker because the application is approved. You just need to get that purchase and sale with that property address. When you get that for us, we have a full application at that point, and we start rolling with that, so we have the property address. We might ask for updated payment stub if it's been a little longer than the 90 days. But you have that leverage of having an approval. And it's just, let's say you could close maybe a little quicker than someone who hasn't even applied that. Because in the beginning of the process. And that's what we've had with feedback from people, that's a really good benefit. It's much better.
I missed, thank you so much.
Yeah.
I missed one information about the different scenario for as a down payment amount.
Yes,
We should put down as a first time home buyer. Can you please go back a little bit?
yes, of
Yeah.
course. So, with, off the top of my head, for a single family or a condominium on a fixed mortgage, meaning that your interest rate will stay the same throughout the life of the mortgage, it's a minimum down payment of 5%. If you put 20% or more down for a down payment, you don't pay that additional insurance every month called PMI. Because it's considered less risky for the bank in case of a foreclosure. And with markets fluctuating too.
Oh,
And
and
what more people getting?
The multi-families is 25%.
15 on a 2 and 20.
15 on a 2, sorry.
But you can also get the down
2 family would be 15%. Okay.
down payment can come from a gift from a family. So have set for us, we have a process to document it, but we can use gifts for that as long as they have to be approved. And if that, and we don't have a lot of time to go into all the different possibilities, but there is a down payment from a gift is permitted from a family. Or what a loan against your 401k, you can do that. So,
Did we miss anything else?
I did not miss anything, but there is something I'm not clear about it.
Yes.
It's a PMI.
PMI. So PMI is an additional insurance you pay that gets added on your monthly mortgage. That insurance protects the bank in a scenario of a foreclosure. So what happens is, say your house is worth 100,000, you borrow 95,000. And for some reason, we have to foreclose. If for some reason we have to sell the house and there's damages in the property, et cetera, by the time we sell the house and get our money back to pay off the mortgage, it costs us more than what you borrowed. It protects the bank. It's nothing for the borrower, it's an insurance for the lender. And that insurance gets determined on multiple factors, location of the property, because market fluctuations, how risky you are, for example, like credit wise, if you have a low credit score, the insurance goes up. If your debt to income is high, meaning you have a lot of monthly payments compared to how much you make, you might be in a little tighter position, so the premium goes up. And a few other factors, which I don't remember off the top of my head, but again, it's not something we quote right away. We have to run numbers with the insurance company and they get us back how much additional you'll pay a month for that PMI. Is that a little?
Yeah.
Okay. Yeah, it's just an insurance for the lender, which you pay for at least 2 years. It has to stay on the mortgage for at least 2 years. At least 2 years. Or if you reach 78% loan to value. So if the house is 100,000, you reach the mortgage at 78,000, it will come up. That PMI. It's not forever.
If you hit that 78, it will come.
Yeah. Did we answer everything?
Yeah.
Anybody else? No?
Oh,
Oh, you're doing a question at the end. Sorry. Okay. Sorry. Yes, bye.
Questions at the end?
Yeah.
Thank you. Hi, everyone. I'm Stephanie Weinstein. I am your local real estate agent. I work with Coldwell Banker. We have offices in Sharon, Easton, and we have offices all over the world. So I can help you wherever you want to go, all over the world. And you are so lucky. You are in such good hands with a Sharon Credit Union. Because I will tell you, as a listing agent, I sell a lot of homes. So I see a lot of pre-approvals. And if I see a pre-approval from, let's say, a Rocket Mortgage, and I see one from Sharon Credit Union, guess who I'm going to go with? I'm going to go with Sharon Credit Union. So your most important piece is to get your pre-approval from someone reputable. So you guys are in great hands. So that's the biggest piece of the puzzle is your pre-approval. Once you have your pre-approval, now we can go shopping. And so we can start and I want to introduce Tony Soares too. So Tony Soares is on my team. And I just want to say that I have a team of 10 people. And so we're always available to show properties. And we're a top team too. We're top 1 or 2% in the country. Not trying to brag.
You can put.
So, all right. So let's see. That's this. Okay, so I am a buyer's agent and I am a seller's agent. So it depends on who I'm working with. So my favorite buyers are the first-time home buyers. I love you guys. And I walk you through every step of the process. And I want you to understand that your money is always going to be protected. So I don't want you to be scared of putting an offer in because my job is to protect your money. And I do that every step of the way. So we'll sit down. So once you get your pre-approval from Sharon Credit Union, I'll be very excited and we'll sit down and we'll talk about what kind of home you're looking for. Are you looking for a condo? Are you looking for a single family home? Are you looking for a multifamily? So I'll intake all that information and we'll find out what towns you want to go in. Like I said, the style of home, your wants and needs, and then we'll find out how much you're pre-approved for. So what happens is I will then put you on MLS. Is anyone on MLS yet? You're on MLS? Okay, good. So you get updates every day when something new comes on the market for what you're looking for. So this is very easy. And after we leave tonight, my information, I have a gold packet that you're going to take. My card is in there. Tony's card is in there. You can just email me and you can start shopping from home, right from your email, just so you can start getting used to the market. What do things cost? So it's a good way to start. Then once you have your pre-approval, we're all set, then we can actually hit the road. So you can start going to open houses. That's a great way to start shopping. And when you sign into an open house, you can just say that you're working with me, just so nobody calls you. So you can just write down Stephanie Weinstein, Coldwell Banker, even if we're not even working together, if you don't want to get a million calls from that realtor. The other thing I did want to mention, because I don't know if you guys are nervous about this, but there's a new law that came out, and I don't know if you think you have to pay to use a buyer agent. So I don't want you to be afraid of that. So far, everything that my buyers have put offers in for, and all the sellers that I have been working for, they are still paying the buyer agents. So you really don't, I have not run into yet, maybe Attorney Syed can speak differently, but I have not run into yet where a buyer has to pay their agent. And if by chance there might be, maybe there is a little money you might have to pay, there is a way to roll that into your mortgage. And you can talk to your loan officer about that. But I swear I have not run into it yet. So you'll enter a buyer agreement with me or whoever you use for an agent. And it could be a 1-day agreement. It could be for 180 days. But I do want you to not be afraid to use a buyer agent. Okay? Because the other part of that is too, the seller goes into an agreement with the listing agent. And there's a part on that contract that says if an unrepresented buyer comes in, let's say I'm the listing agent, I am still going to get paid probably for you if you are unrepresented. So it doesn't make sense to be unrepresented because if I'm the listing agent, I'm still getting that money. You need to have buyer representation. It's very important to have a buyer agent. Okay, so how to find a home. So I told you we're going to start online. We're going to set you up on MLS. Then you're going to start going to open houses. And then we can, if you see something that you love, I'll go see it. We'll go together. That's pretty much it. Making the offer negotiations. So that's when I sit down with you when we first meet, and I'll probably give you like a blank copy of an offer, and we'll go over the offer. So it might look scary, but it really isn't. And just to go over it very quickly on an offer, you put $1,000 down with the offer, but nothing gets cashed until our offer is accepted. So once our offer is accepted, then they will cash that $1,000. So that is to hold the home that you're putting an offer in on. So now we're in a binding agreement because you put down that $1,000. After we do that, we then have a home inspection. So I have home inspectors that I've been working with for 14 years. So I can give you a list of home inspectors and you can make calls and figure out who you want to hire for a home inspector. So let's say we go into the home inspection and the house is a piece of crap and you want to back out. Guess what? You get your $1,000 back. The only money you don't get back though is the home inspection money. Okay. So now we have our $1,000. So that goes towards your purchase. We have our home inspection. It takes a couple hours to go through the home inspection. They check everything. And you don't want to give up that home inspection. You want that home inspection because you want to test for anything. There could be termites. There could be structural issues. You want to make sure that you are checking out that house head to toe. Now, after the home inspection, it's not for us as your buyer agent, it's not for us to make a list of everything that we're going to give the seller to fix. That's not what it's for. It's for us to find out what you're buying. And if there's any safety issues, electrical or whatever it is, that's something we would go back to the seller and say, hey, Mr. Seller, there's electrical issues. We want this fixed. So it really depends on, what the things are. So once we go through home inspection, now it's time for purchase and sale. So now purchase and sale is when you give a bigger chunk of your money, whether it's 3% or 5%. So now you've put down $1,000 with your offer. You've had your home inspection, and now we have our purchase and sale. So you have an attorney here that will look over your purchase and sale and be on your side and make sure that everything lines up to protect you. So the buyer has an attorney and the seller has an attorney. So the seller's attorney whips up the P&S, they send it over to your attorney. Your attorney looks over the purchase and sale and makes sure that you're completely protected. So the attorneys go back and forth until they both agree, this is perfect. Then you sign the P&S and then you hand over your whatever it is, $5,000, $10,000, and that gets held in escrow. So now you have your $1,000 in escrow and your $5,000 or your $10,000 or however much money you're putting in escrow. All that's in escrow. Now you're working on your loan and you have to get all of your paperwork in. Get everything in. The more paperwork that you can get in up front, the better. Right?
Thank you.
Yes. And this is the most important part because we only have a certain amount of time for you to get your loan. So you've got to get your pay stubs in, whatever they are asking you for, you've got to get it in quickly. So you get all your paperwork in, then we get the clear to close. Now, if there's an issue with your loan, for whatever, sometimes things happen. If somebody from the loan department calls and says, we can't get the loan, and they call me, Okay, I immediately call the other agent. I get a release and I say, we're out. We can't get a loan. And then you get all your money back. So you get your $1,000 back that you put down with the offer, and you get your purchase and sale money back only if you get denied the loan. It usually doesn't happen too often that you get denied the loan because you're working up front with Sharon Credit Union, and they're going to have all of your pieces in a row, and they're going to be able to. So I highly doubt that that would happen. It doesn't happen very much at all. Yeah. So what else do we have? Loan commitment date. So, yep. So I follow along the dates. Again, we have our home inspection date. So we have that home inspection period where we can get out of it. You would get your money back if the house wasn't good. And then we have our mortgage commitment date. So I make sure on that mortgage commitment date, are we all set? Are they going to get their loan? Yes, then we're good. And then we go to closing.
But the only thing I'd add is, she had mentioned the home inspection. On average, it's usually around $300 to $400 to pay for that, and then she said that's not money. But it's well worth spending that money. Make sure you get it.
There's no advantage by not getting a home inspection anymore. And I think they're passing actually a new law. They're putting in next year that you have to have a home inspection.
But about the market, it's required.
Signed it. Sorry. But the home inspection is very important because I've seen and worked with Cambridge, we had a borrower that she waived her home inspection. We waived it, and then the house needed tens of thousands of dollars and she wanted out of the contract.
You couldn't, right?
Don't ever skip a home.
I never, ever, as a buyer's agent, I would never, ever tell you not to get a home inspection. You know, it's up to you if you don't want to get one, but I would never, ever advise it. Unless you're buying a condo and everything on the outside is taken care of by the condo association. So if they're taking care of the roof and they take care of the siding and they do all that outside stuff, then, and if you know on the inside that the water heater is newer and that the furnace is newer, then maybe, but if it's, you know what, new things happen in new construction too. But usually if you buy a new construction home, there is a 1-year builder's warranty. So that would protect you.
Scott Syatt. Closings for Sharon Credit Union, attorney. And some of you are taking notes, so I'm gonna have you write down some of these things right from the start. Well, first of all, I want to say that the president of Sharon Credit Union is here. You may have seen him on TV. He's not even a lot of commercials. Okay. First thing to write down. Make sure you record a homestead on the day that you record your deed. Okay. Homestead, it just changed. It's going to protect the equity in your property up to $1 million. And once you record that homestead, it's good for as long as you live on the property. And once you turn 62 years old, if you're married and you have a spouse that's 62 and you're both 62, you have a $2 million exemption, which means if you're driving down the road and God forbid a kid runs out in front of the car and you hit them and kill them, then no one's going to take your house away. So that's just an added protection in addition to all the insurance you may have. Don't schedule your closing on a Friday. If something goes wrong and you're all set with the movers to move in and do your painting and do everything on the weekend, and you don't go on record, you're gonna have to wait till Monday and you're gonna have no place to go. Pay attention to the dates. So when you do your offer, you're going to be talking about a commitment date, meaning like when you get your loan commitment. Make sure that it's a reasonable time that you give yourself to get that commitment. Right? I was going to ask you, with the Smart Start, does that accelerate the commitment? You essentially have a commitment when you
Well,
have a
if
smart
it's a
start?
commitment subject to the appraisal, the purchase and sale of the business. The title work.
Okay,
Yeah.
so, right, so the appraisal, what they were talking about before, that might be another way that you might lose a commitment, right? That you would
Yes,
get the
well,
loan.
if something happens, appraisal that could property substandard or maybe the value of the house is supported.
Comes in.
Yeah.
Most transactions, I wrote these things down too. With the right people involved, this. If you have the wrong people, if you don't have a good broker, it can screw up everything. If you don't have a good lawyer, it can screw up. If you're not working with a good lender, it can screw up. So just keep that in mind. As everyone said from all of the different speakers, make sure if the bank or the lender is asking for something, give it to them as fast as you can. Because the faster you have to be good too. And if you're giving them the right stuff, then you're gonna get this stuff done quickly as well. I always point out, this is maybe my, I don't know, I'm gonna measure it. This is probably my 100th first time home buyer seminar. Sharon Credit Union definitely has the best and lowest fees. So like, for example, if you're gonna go to Bank of America, they're gonna charge you an origination fee. It's gonna be $1,500. It goes to nothing. With Sharon Credit Union, they charge you the bare bones. And so that's saving you money, and that allows you to put more money maybe in your offer to make it more attractive to a seller. Why do you want an attorney? Additionally to just the legal aspect of things, it's an emotional experience when you are buying a house. So, and if you're selling the house, so sometimes you need an attorney to speak for you so that you're not put off by something maybe that the seller says. And then two lawyers can talk to each other and iron things out. There was a big trend over the past, this market's crazy. So people were trying to get ahead of other people by saying, no inspection, like Stephanie said. I would recommend an inspection as well. Even if you're gonna lose the house to somebody who did no inspection. There's a trend that I noticed, especially with younger people who are buying properties, they think that contracts don't matter. So they say, okay, I'm gonna go no inspection, and they win the property. And then when they go to do a walkthrough and they find out there are all these issues, they want to back out. And then the lawyer, like me, says, well, you can't. They'll say, well, there's a problem with this, this, and this. And I said, well, you did no inspection. Well, I want out. You can't get out. So that is a way to lose your money, and it's not worth it. And if you're gonna go no inspection, if you have to rush anything for a big purchase like this, the biggest purchase of your life, then it's not worth making that mistake. So go on to these slides. So what'll happen is, another thing is when you do your inspection, the inspector may come out with some things that need to be repaired or some concerns that he or she may have. You want to make sure that that goes into the offer. Because when Stephanie sends me the offer for me to do the purchase and sale agreement, I'm not going to know about any of those concerns unless they're in the offer. And you've agreed to that in the offer, and that I put that into the purchase and sale agreement. So the seller also is going to get that offer, and they're going to put in these predetermined agreements that you've made with the seller in order that you expect to put in the purchase and sale agreement. So if there's even if you love a chandelier that's in there, I want this fixture that's in the kitchen, that goes into the offer, right? Because what you're doing is you're taking everything that you're verbally saying and you're putting it into a document that makes it binding on everybody. It doesn't matter if it's in the MLS. You can't say, oh, I saw this in the listing, but it's not in your purchase and sale agreement. If it's not in your purchase and sale agreement, it's not in your deal. I just had something recently with a guy who thought he was getting more parking spaces than he was. And he didn't do any due diligence, and he wanted to back out like a week before it was a $2 million property. He wanted to back out a week before the closing, and he couldn't back out, so he had to negotiate his way out of $93,000 and ended up losing $40,000. He was lucky that the sellers didn't hold him to it. Okay, but that's something he should have investigated before he signed the purchase and sale agreement. But your broker, if your broker's good, they're gonna check that stuff out with you, right? So these are just what goes into the purchase and sale agreement. It's the legal obligations of the parties, property description, the price, obviously, what your deposit is. You're gonna have your date when it's supposed to happen, and that date can change if it needs to. But you're gonna put a date in the first place. Broker fees, we talked about that, who pays when paid. I've seen one situation where the buyer paid part of the broker fee, but the brokers seem to be finding ways around that because it's not that, palatable to the buyers. The mortgage contingency is that date where you're going to be getting a loan by, and that's how you can get out. So if you don't get the mortgage, the commitment, like we said, then you can get out and you can get that money back, as Stephanie said. Environmental inspections, radon, sometimes they'll do a radon inspection, but that'll go in the purchase and sale agreement too. If they've checked the radon and it hasn't come back yet, then in the purchase and sale agreement, we might say that it has to be at this, acceptable level. And if the radon comes back, that's another way you could get out of it. If it comes back and it's too high. Or they could put a mitigation system in. No seller has ever not agreed to put a radon mitigation system in. We talked about that, the buyers and sellers obligation. All right, title insurance. Do you need title insurance? The answer is yes. There's no question about it. The lender's going to require you to get a policy. So if you go to sell this property and there's a title issue, then the lender's covered, but you also have to get your own owner's policy. It's a one-time fee, and it all depends on price of the property. So once you have that owner's policy, let's say that you go to sell the property and there's a missing discharge from a previous owner that was not caught in a title exam from 20 years ago. The owner's policy will cover it, and then you'll be able to streamline and continue to go through the transaction. Most likely the day of the closing or the day before the closing, you'll have a final walkthrough. Hopefully nothing will change from when you put the offer in. Sometimes things do change. And if there's something damaged, then you'll have to work that out. And that's another reason that you want to have lawyers talk about that. You call your lawyer and say, hey, there's, the lawn hasn't been cleaned. There's a bunch of trash in the back. They didn't remove it. So then I call the seller's attorney and say, what's going on with this? And they might say, oh, we didn't get a chance to move it. Those people moved to Texas. They'll give you $1,000 credit to get rid of it. And then you just keep going. Having the right people in place is just going to get the transaction done and get it to keep going. You don't want any roadblocks. And then what'll happen is once the closings are a little bit different now. Before it used to be like the size of this room with all these people in it. Now the sellers do something, they call it a mail away. They'll send all their documents ahead of time. So usually it's just me and the buyers. And it can take, it could take 35 to 45 minutes. It all depends how long you want to talk to me. But otherwise, you just sign all the documents and then you leave, and I'm able to upload everything to the registry online, and then we're on record within a couple of hours. So it works out. It's really efficient at this point.
Can I say what?
Yeah.
When Scott was talking about, if, for example, you like the chandelier, you want to have that include, like what Scott said, you definitely want that as part of the purchase that includes chandelier. But if you negotiate with the seller saying, well, I'll pay you this for your dining room set, that you don't want to purchase.
Right, you do that.
Yeah, that has to be separate, because then what happens? Say, okay, I have to buy these items. So you want it all inclusive. Anything you want to buy from the seller, like, a lawnmower,
Yeah, kitchen
generator,
table. Yeah.
that's separate.
Right. And just don't assume that everything's included. When you're with your broker, say, is this going to be staying here when they leave here? Sometimes it's not. Sometimes it could be a built-in, and the seller might think that they're going to take the built-in off and put it somewhere else. Facility, but they might do that. Then you come to your walkthrough and it's gone. So you want to make sure that everything is out there and in writing, because everything in real estate has to. Questions while I'm up here? I mean, everything evolves over time, but if you have the right representation, and the right advice, wish you guys luck. I hope you find something good. And dealing with Sharon is really a dream. So I deal with other places, not just because I'm in here. I've been working on it for a long time. In fact, I have my, so I'll give you an idea. Sure.
Thank you. I have it. Okay. So Sharon and Crescent Credit Union, we have a great first-time home buyer program. This is a nice deal. So it's let me start with this first. The definition of a first-time home buyer. Somebody that's buying a home for the very first time, which is all about it. It can be somebody that hasn't owned a home within the past 3 years. And it can also include, say, the matter of divorce, that type of situation that you're leaving a joint marital home. You can be considered a first-time home buyer that way. The product that we're going to talk about today is our 5-5 program. It's eligible for 1 to 4 family and condos. Has a low down payment of 3%. So we will lend up to 90% of the purchase price, which I know that we've been talking a lot tonight about having at least 5% down. This will make you eligible for only putting 3% down. And it's based on income limits. So let me go into this a little bit more for you. So the 5-5 arm, that means for the first 5 years of the loan, the rate is fixed. So whatever the rate is starting at, it's fixed for the first 5 years. The rate after that first 5 years can change. It can either go up or down within 2 points. Okay, so you could, it can go up or down 2 percentage points. Thereafter, every 5 years, the rate can change again. And it's another case of it can go up or down that 2%. So you're fixed for the first 5 years. It changes every 5 years thereafter. The max cap on that, I believe, is 5%. So whatever the initial rate is, say it was, I don't know what the rate is right now. I didn't even look. So let's just say it's 5%. Let's just say it's 5%. The most the loan would ever go up is 10%. Like it could never exceed 10%. So it has a cap on it for the 5%. The source of down payment on the 3%, that can be a total gift from a family member. To be eligible for that to be a total gift is that you would have to have a credit score greater than 680. And your debt to income ratio has to be less than 45%. Okay. So when we pull a credit score, if there was 2 of you on the loan, we take the middle score for each of you and we use the lower of the 2 scores. So that way, the lower of the 2 scores. If it's an individual application, you'll have those 3 credit scores. We'll use your middle score to determine what your credit is. So if you do fall within the greater than 680 credit score and the less than 45% debt to income ratio, you would be allowed to have the total gift for that 3% down. So you could use, a family member. Somebody's going to have a nice rich relative out there that's to give us the down payments. As far as the income limits, this program comes with a $500 first-time home buyer credit. Okay, so everybody's eligible for that. If your income limit is based, we use the area medium for income limit for where you're buying the property. If you fall within that 115% income, you can qualify up to $1,000 closing cost credit. Okay, so everybody's eligible for the $500 closing cost credit. But if you're within that median, 115% medium income, then you are eligible for the $1,000 closing cost credit. And just to give you an idea, it is a hefty amount of money. So the median area income for the Brockton area is $109,900. And at 115%, that's $126,385. So if you're on the loan individually, you can earn up to the 126. Is that based? Yeah, it is based like that, correct? Total household. It doesn't matter if it's single or, yeah. If there's two borrowers and you're under that 126, you'd be eligible for that $1,000 credit. The Sharon area, their area median of income is 148,900, which actually comes out to 171,000 plus. So if your combined income, it's who the applicants are on the loan, whether it's individual or joint, the two applicants' gross income combined. So that's
only one applicant. One applicant for a single person.
A single person, it's the same thing, right?
Yes.
We have confirmed that. It's the same thing. So it's per household, but it's based on the applicants on the loan. So applicant or applicants on the loan with their accounts. So that's a great opportunity for that. The loan would require mortgage insurance, PMI, if it at the 97%, but we have worked out a deal with the mortgage insurance company, so they've agreed to go up to that 97% mark for us. What else? Let me see. So here are some, did I cover everything on that? I feel like I did.
We were talking about the today, this current 5.5 on rate today is 6%. So 6%, and our 30-year fixed is 6.875%. So our adjustable rate ARM products are lower than our fixed rate products at point in time. So for this ARM 6%, you know, it's a reasonable rate.
Yep.
And it is fixed for 5 years. The most it can go up is 8%. So when you say cap 2%, so the most it can go up for the next 5 years up to 8%. 6. And the most it can go down, if rates go down, well.
So, and given the way that the market is right now and the rates and stuff, I mean, it's a great way to start and get in. You can always refinance down the road, you know, if those fixed rates actually hopefully come down. I don't know if they'll ever be what they were, which is sad, but definitely a good way to at least start. And then if you wanted to switch and refinance down the road when the rates get better, then that's a great option. Credit scores, whereas the first-time home buyers, we have, if your credit score is less than, I find it, search for, it is a 620? Yeah. Okay. So if your credit score is less than 620, or if you needed to provide use non-traditional credit, so maybe some personal, maybe you provide us canceled checks to show us paying your rent on time, maybe paying some of your utilities or cell phones, that type of thing. If you had to use alternative credit, at least one of the borrowers on the application would need to complete the first-time home buyer course. We were lucky enough, we did find a free online course through the fanniemae.com education. Is that correct, Martha?
Yeah.
And then there's also, that's just the budget worksheet on the top, right? Okay. And then there's also that greenpath.com, the fanniemae.com, Martha and I kind of went on a little bit, and it's a long program, but you can stop it and finish it as you go, as time allows you to do. But it's free, it's online, probably a great thing to do. So if you needed to either use that alternative credit, or if your credit score's a little low there, one of you should probably complete the course. And it gives you a completion certificate at the end of it, or whatever that you can present. But yeah, and did we print off that budget worksheet in the file?
Yes.
Okay, so in your folders, you'll see that budget worksheet as well. That's actually a really good, I think the one that we have the website on is actually interactive. I think you can plug everything in and it will calculate everything out for you as well. And then that's
A wrap up. Okay. Well, I know it's been long. I appreciate your patience. We do have a company called Green Path Financial. And we have, it's a relationship with them. They offer really good services for counseling, credit counseling. If you needed some help with credit counseling, or to establish credit, to fix credit, they're free. We gave you the link that was on that page, that's in there. And we also gave you a little more information about them. But we have had some feedback that they are really a really useful company to use. I don't know if they're nonprofit. I have to consider, I can't remember. But we've been working with them a while. So we just do that in there for some more background, information and resources. Does anyone have any questions for any of our speakers? Yes.
We acting to acting straight line.
Mhm.
Are these loan or utility?
on your credit report. So if you were to have like 3 credit cards, that establish 3 accounts, so they could be a loan, they could be a credit card, they could be. Do they do that for the utilities when you self-report? If you self-report, you know that, Robert?
I don't know if that's well considered this a trade.
Well,
I
I
think
mean,
so.
I know that, I think I do. You can actually add, they can start reporting utilities. We don't count that in debt because that's not part of how we figure it out, but they can put your utilities in. But on the 5-5 arm, do they do the alternate credit on the 5-5 arm? No, okay. So if you don't have the trade lines, we can do an alternate credit history, which would mean we would look at how you paid your rent for the last 12 months, and we take utilities like your phone bill, electric bill, your cable bill. And
Car insurance, anything like that.
if you paid all that on time for the last 12, if we're going to look back at the last 12 months, then that would be called alternate credit, and we could work with that. We'd be able to work with that.
But on your credit report, your credit report looks for at least 3 active credit accounts, or 3 active trade lines to be able to provide a credit score. So that would be like if you ended up having with the charge cards, anything like that, a car loan, installment loan, anything like that. That would be the 3 active.
You're basically.
Nope, because that's what you would need to get to actually have like the credit score, but as like Robert said, you can do that alternative credit. So you don't have to have the 3 active credit lines, you can have the alternate. Sure.
People say that they give us a number of time, but it needs to be coffee.
After deposit, it has to be in the account up to closing. So, for example, so if you have a parent that says we 5,000, you would have to see the copy of the check. We'd have to see that money went into your bank account and deposited and clear. Okay, so we have a paper trail, and there's a letter that has to get notarized. You have to go to the branch or somewhere and they would notarize a letter and say, you know, parents giving you the money, the amount, the date. So there's a procedure on
The
that.
actual donor gives has to sign it.
I think your question may be based on if we do collect your bank and investment statements for a 3-month period. We're gonna look at those. If there's a large deposit in there. And it was the gift and you say, oh, that was the money my parents gave me. The down payment. At that point, we're gonna say, oh, we're gonna need a gift letter for that because we have to verify any large deposits in those bank statements. For the items that we've collected. As long as it's deposited before.
And you will get, Robert was saying, a gift affidavit, which the person who's giving you the gift signs. That this is, I have a relationship with, I've forgotten the you, and he's my son. And then they sign it, and we actually require a notary.
Yeah.
And one other thing, I just wanted to bring up a really good point. We go on and on about this, but we do look at your deposit accounts. Well, first of all, we have to verify you have the assets to close, the money to close. And if we do see a large deposit, the reason why people question that, we just need to make sure it's not a loan. Maybe it was a personal loan someone gave you and say, oh, okay, what are the terms of that loan? Well, I have to pay them $100 every month. So that's an added side, maybe private loan that you have with the person that we would have to add in as a liability. That's why we ask those questions.
And one more thing, if anybody here does what's called non-traditional banking, which if you use something called a SUSU or a Carter or a Junta, we will work with that, but we would have to see the paperwork. Like, you know, we'd have to, how many people are in it, when it's your turn to get the money, and we'd have to document it that way. So we can work with that with assets if you do non-traditional banking. So that it's something, but usually that works with non-traditional credit. So, you know, for people that are new to this country that are still establishing their credit and their banking relationships. So we can work with those situations. But again, everything is, we have to have a paper trail. That's really important.
Keep trails and explanations.
And we don't care how many times you go to Dunkin' Donuts.
I would be very embarrassed. I got pulled on that. It would be off your job. Yeah. Yeah, it is definitely.
So if you and a spouse are applying for the loan, and you're going through like the credit score and debt to income ratio. I was just curious how you guys like take like the two separate, because I'm assuming we're filling out both separately, like how you combine them. Is it like an average? Because I know like your income together that's what it is, but I was just curious, like if I had like 800 credit score and my wife was 750, like how do you factor that into the loan?
Well, Carolyn mentioned that on mortgages, we run a tri-merge report.
Yeah, it was like the middle one.
And the middle score, we take the lower of the two scores.
Gotcha.
So if you have the 800, she has the 750, we look at the 750.
Okay.
Income wise, it's a joint application.
Yeah.
So we look at the whole thing as one. That's one.
Yeah, and then debt to income ratio, you would both have to be within those.
It's all
metrics.
combined.
Combined.
It's all combined.
too.
So we're looking at your together. That total
Yeah.
credit.
This based on gross.
Yep.
It's on gross, except if you're self-employed, that's net. Because you subtract so many expenses and things out of it, we're looking at, and there's things you can add back in. That's the only time is.
I had
Sure.
half of they close negative credit card balances. Would be smart to pay them back. Could that like be reason why like the lender denies the application? So like let's say you have multiple accounts, like multiple trades, a lot of positive trades, but you have like a few negative ones, but your score is above 620. Are you looking at the report or just the score?
No, we look at the whole report.
Okay.
We're looking at the whole report, and if they're related, were they, like, if they're late accounts, we'd have you explain why they were late. If there were a lot that were real recent, then we might want to see you try to clean that up before you actually move forward. I mean, the better it looks, the better it looks, but I mean, everybody has. Not everything's perfect all the time.
Yeah.
We all run into situations that, but if it's something you can explain, if it's things that maybe you can try to clear up in the meantime, that's why it's good to like pull and take a look at your credit report, and it might find that there's things that you can just pay and get rid of and clean up ahead of time.
Like what Carol said, if the leaks happened months ago, would it turn about the happened? Okay, so timing, it's how long.
Yeah.
If you had a bad, say, 2022, you lost your job, an example, and out of work for 3 months, and your credit suffered because of it, but your job and everything is paid on time, get caught up in the past dues. That's not gonna count against you like it would if you were, or charged off credit cards and you apply for your standard. So it's how long the credit issues have ceased. That actually is part of it.
I know. Mentioned on the slide, it said, self-employment, the profit and loss statement has to be signed. Who does it have to be signed by? Like,
I do.
Oh,
Yeah.
It does not have to be audited.
oh,
Okay, yeah.
in the home. See?
Great question. Massachusetts, and we do lend in Rhode Island. No. You also have to qualify for membership with Sharon and Harriet. Chris United Credit Union. You have to qualify for membership. Residing residing within specific counties. I'm not going to recite them off the top of my head. And certain counties in Rhode Island though as well. So it's not all of Rhode Island. Or you can have a relative.
Which program?
Bristol,
Providence.
Providence, it's a number of
And kind
counties. And yes.
yeah, we want to.
Cumberland, yes.
We have a lot.
We have a Cumberland.
We do.
Or you can have a family member qualifies too to become a member. You have to be qualified to become a member. Or you have family member qualified. It's very nice.
If I have an auto loan with Sharon, I'm automatically a member, right?
You want
Once a member, one member.
Yes. Yes. Yes, please.
So first off, I've got to tell you, you're in great hands here. I learned, I learned a few things from these experts over here that I'd forgotten. So it's great. Things I wanted to ask you, I'm not sure where you guys asking about the qualified to be a member. It's not very difficult. You just have to live really in eastern Massachusetts, eastern out to central, through Rhode Island, basically. So I wouldn't worry. But I just want to ask after that, maybe you guys covered this already, but you guys know what credit unions are and how we differentiate ourselves from banks, basically. If not, I'll take it real quick. So credit unions exist really to help people, not nonprofit organization. So it gives us lots of flexibility to do things for the members and members in the community. Right off the bat, you're a member, you're not a customer, right? So by doing it that way, we're able to invest in the communities, invest in education like this, financial literacy in particular. I think Stephanie nailed it. You guys are my favorite groups to see, first time home buyers. Excuse me. That was something, I guess. So, not really. Water right now. But in any case, and I'll tell you, we really wish, I got my first mortgage right next door, right? Long time ago. And Scott mentioned it too, when I went to the closing, ultimately, there was my lawyer, there was my real estate agent, there was the seller, there was the seller's buyer, there was the bank's buyer. our representative, and there was another one, there was 6 or 7 people, and all I did was sit there and write checks. And put it in. Very stressful, I remember. So, but I would say, it's all coming back to me here, listen, folks, you took a lot of notes, that's great. But if you forget a lot of things, don't worry about it. If you're working with the right brokers, working with the right financial institution, the right attorney, they'll walk you through all the steps. Right? So don't get too on that. What else? I guess that's basically it. Thanks for making it. I know it's a late night.
Anything that I generally say about credit unions or this one in particular is like, are going to, and they're one of the places, there's nobody that you can speak to. You could talk to the president of the credit bank, can you talk to?
Sure. That's true. I do it all the time. I give you my card. Like,
Favor to ask everyone in your template here, we have a survey. You wouldn't mind. Right on the right side.
You have a lot of food here, so please have a funny.
Yeah.
so thanks for taking the time tonight. And thank you guys here on the left. You know, it's like families and other things we didn't think about. Thank you.
Did want to mention one more thing too. So when you're working with Sharon Credit Union, you're working with me or Tony, and you find a house, what we would do is we would send that listing over to whoever working on your loan, and they're going to work out your monthly payments for you. So with every listing, with whatever house you're interested in, we'll get those monthly payments for you. And also I want to let you know that Tony and I have our license in Rhode Island as well.
Yellow envelope is bag. So being the gold envelope. You open that up. Bags it's in the.
And I would like.
Yeah. Yeah.
I have.
Oh, okay.
Good.
Thank you, dear.
If any of you are anything like me, the 3, 4 questions in the packets, my business card is there with my email. You can call me, you can email me if you have questions, if not when you leave here. I know I'm famous for the questions submitted, the people that are trying to get out of it.
Thank you.
Everybody. Call us. I don't even.
Oh, yeah.
We left work tomorrow. Yeah. Probably learn, yeah. Yeah. Oh, yeah. This is great. I know. I love it. So excited. I grew up there. Yeah, thanks. Yeah, my father made it right. Thanks. That, yeah, we lived on, so we.